Rate cuts are coming, fear is rising, and the market's already guessing the outcome. The problem is most people look at the wrong signals. In this video, we cut through the noise and map what a policy shift really means for equities, bonds, dollar strengths, and the sentiment. And we'll share you my view on a couple of trades which I'm looking at and where I see markets going after the cuts. Let's dive in straightforward. And today we have a special guest again. Arthur is also going to be in the background telling us his views and what he's also seeing. What I'm seeing over here potentially is the cuts, right? The problematic of cuts. We can see it clearly over here. I have analyzed a couple of cuts, right? Since 1999. When we go over here, I have done the analysis manually, of course, and discretionary, and I will tell you what I have figured out in this video. But first of all, let me show you something very interesting. The thing is, when the cuts happens, always market crash follow it. I wouldn't call it market crash exactly, but at 20%. And everything about 20% for me is a recession. And it's going into a recession. Is it a crash, right? It's pretty fast move in 2 months to have a 20% correction. In 2024, from September 17, which is exactly our today, September 17 cuts, right? And second one and the third one, if it happens, then after that drops almost immediately. If we watched over here, right, in the third cut happened 2024, almost 5% instant after it, right? The money being pushed into the market. Majority of people thinks, okay, if there is more money in the market, businesses are getting more, and a lot of relief happening in the economy, and the purchasing is gonna go high, the spending of the retail gonna go high, so we will have more money, right? But exactly after that is happening the opposite. Why? So I will showcase you why it's happening and what to look for. The first cut in 2024 and the second cut were very bullish, right? So when we watched that first cut had a 7%, second cut had almost another 2% added to the whole industry. And one thing is very important and interesting. You see after the third cut, we saw a correction, right? I'm gonna make this too wide. We see a correction over here and a consolidation, right? So majority of people would be looking for something like this. Okay, everything is still looking good. Bam, it's going to the downside. A leg. And I'm not big Elliott wave, but Arthur is a big fan of Elliott wave. And I can see clearly when we turn it to white again, that's an ABC correction happened, right? A leg down, from my view, it would happen something like this. I would have put in this, a leg down to the downside, right? So using very simple technical without watching the volume, sentiment, etc., right? Let's right now just analyze the technical, what we have just saw. And it looks for me like a very clear ABC correction. Will it happen again if we took this ABC, right, and took it to the forward to 2025 right now, right? Are we in that phase of that correction, right? The third cuts happen over here. The markets go higher, right? And then lower. And fake everyone. And we see a leg down, an A, B, C, right? Something like this. Let me make it white for you too. And we have a 20% correction also, right? 20%. Wow, this is going to be pretty much to 500, right? So we're gonna have something like this. It's pretty crazy dump. What will you do if that's happened, right? So the only thing was I was thinking about, I think I have Fortuna. Anchor Fortuna is using probabilities to calculate where the market could go. Okay. So still bullish based on that last, let me check the settings, the last 1,000 days, okay, no, the last 252 days, okay, and This is a simulation to figure out where the market could go up or down, right? What is happening is very clear. It's very clear. As is in the last 250 days, the market were very bullish. But what if we done 1,000 days, right? What's gonna happen over here? In the last 1,000 days, if you put that in the last 2 years, right? More than 2 years, 2.5 years, this is gonna tell us is the market gonna go lower based on all the data of the last 2.5 years. What if we put 3,000 in it? 3,000 days, what is gonna tell us, right? The probability is still there, right? This is basically statistic is telling us in the last couple of years, all the data collected and the probability of going lower is very high. Okay, so the statistic is telling us. What we can see right now also additionally on top of that, we can add here we can add something over here. This is actually that Fortuna is based on Monte Carlo simulation. So more on Monte Carlo, you can just Google it and figure it out yourself, or just write it in a comment. I will share it with you. So the green lines over here is the vertical green lines means the Fed has added, okay, has added more rates basis to the interest, right? So basically, say it, if the rates was today 3, 1 green, it means it has added another 25 points. This is kind of 3.25 point percentage rates. And each time those rates, okay, the housing market boom, the .com bust, right, the .com boom is always following, right? So the housing market crash, the Great Recession, and the Great Recession took forever, right? Took forever to recover from it. And after that, we had a pretty much another returning to normalcy, right? So it has, again, we are moving in cycles. Markets moves in cycles, right? Feds need to always to adjust. Add rates, cut rates, add rates, cut rates. It needs to move those cycles, right? We had, again, adding a lot. Market was in recession, right? Almost in between 2022 up to 2023, right? The corona taming inflation, right? And from there, the market just boomed. It was just like a rocket. Right now, we're just making a slight correction. So I would assume, okay, we could go down up to 400, 430, maybe, who knows? But the most important thing is we are now in the red cycle, right, where the market drops. And the probability of the last 300 days is telling us statistically. So what I'm seeing over here on the green side, right, if we watch from the backstory, okay, you see cut, markets go up. Adding interest. Green means adding interest. Markets go 20% higher. Market correct itself, go to the entry level, right? If you were a buy and hold person, right? If you bought over here in 1999 and you decided to hold it till 2000 September, right? Even 2001 January, there you would have a return of 0%, and every trader would have a return approximately of 10% or 20% if you are shorting the market too. That being said, it's very difficult to figure out the timing, etc. But I will show more details about that later in another video. So what I'm seeing, the cuts only happens when the markets already stinks. The cuts happen when the shit stinks. Let's see over here, right? So we have over here first cut, second cut correction, third cut, market a little bit recovery, right? And continuation, cut, and the market dropping, even continuing to drop, right? So after that, the market is recovering, and base is added, which is exactly what's opposite happening, right? And interest being higher, borrowing being expensive, And despite that, the market is still pushing high, which is very interesting. After that cycle of pushing the markets by making borrowing expensive, it comes making borrowing cheaper for companies, bailouts, etc. Right? Buying bonds, banks, and monetary easing, right? Which is called monetary easing over here. So after that, we had seen a correction again of 57%. You would have lost if you have invested 100 million. You would have left with 47 million, right? If you bought on the top, if you don't know how to analyze the stock market, right? And the financial and macro and micro economy is very simple, but you need to understand it. And there is a lot of bullshit out there, right? You can ask me in the comment what my views are, my personal views. Happy to help. But again, the a next cycle of adding rates and making it expensive. Markets go up, up, up. Markets going too much up. Crash. 2000, right? Maybe the Fed saw something is happening, and for that reason, that crash happened. And after that, it just exploded, right? Which is pretty an anomaly. So after the cuts, crash, which was pretty fast, and the recovery was even faster over here. So over here, while it was crashing, another, okay, while was it crashing, basis interest rate is where added, which means market gonna go higher. After that, markets go higher. Here, again, cut, very fast. It's always following fast cuts. When fast cuts happen, the market drops. So let's see. Market drops 50 basis, minus 25, minus 25. Market drops. Again, right now it has been talking about a third cut in December happening. Will that also accelerate our ABC correction over here? Maybe, right? Which is based on historical, right? This is always looking at historical, right? And the history is telling us it is repeating itself. It's very simple. And if you understand the Fed cycles, it's very simple. Everything is moving in waves. Look for waves. But right now, let's analyze the whole crypto market, right? Or before we do that, Arthur, do you have anything you would like to share, or you have any minds?
Well, I think that covered some very valuable info there. I don't have too much to add personally because, market is in a very interesting situation. It seems like one month the expectation is bullish, the next one it's bearish and bullish and bearish, and we can see that in the price action since September. We've just been going sideways, right? So, um, looking at things now, I think that knowing we're going to get some information in December, you know, let's say we do get a cut, we get an interest rate cut the first week of the December. Do we get a big drop? If we do see a drop, perhaps that's a sign of some major problems, or even within the next 30, 60 days, as you illustrated, right? Um, Seeing this analysis, maybe it might even be better if we don't get a rate cut. Maybe if they just hold rates the same, that might be better for the market. But let's talk about the immediate short term here, what I'm thinking. And I think that right now we've seen a very basic ABC correction here on both the
So
short
would
term.
you, before, sorry for interrupting, would you like tell us a little bit more where is the ABC coming, the pattern, right? And is it actually working, and when to use it?
Of course. So, yeah, we're seeing an ABC. Well, what we would justify an Elliott wave is an ABC correction. What an ABC correction is, for those that are new to Elliott wave, is essentially a measured move target. So you have a leg down in a certain direction, followed by some relief, and then an identical leg down in terms of size, so that you end up having a similar extension for the correction. Now, one thing that those who are new to Elliott Wave, and those who don't understand market direction as much, when you're looking at charts, whenever you're seeing trends that are very clearly setting higher highs and higher lows, these moves are generally called impulsive moves. Whenever you start having moves that acting like this, choppy, whether they overlay over each other, those are generally corrective moves, right? So we can go back. I think Mo, you already showed it before, but back in April we had this major ABC correction here, and you can kind of just see how these patterns tend to repeat themselves over and over and over again in different ways, right? We had the tantrum over here in August of 2024. Then we had this tariff tantrum. We've had similar type of corrections in the past. We've had combination corrections. So let's talk about the first one here being this ABC, and then I'm going to get to what can be the next situation. So, very simply, if you want to find an ABC pattern, you're essentially looking for a move that corrects. And then what I like to do is I like to use a fib retracement to get an idea where this correction is supposedly looking to end. And that way I can and you kind of project. So if you take out a trend based fib extension, go from the start to the bottom of the move to the top of the move. If you pull that out, you can see that your one-to-one extension lines up just about here where the correction ends. With ABC corrections, they end on high volume. This is a key with Elliott wave, that whenever you put in a major low, you also want to see high volume. That's a sign that it's high probability that the correction is over, right? So you're looking at a few things. You're obviously looking at the relationship between each wave. And I know Mo also looks at time as well. You can use time trend-based Fibonacci's, for example. We have a trend-based Fib time. If you pull it from the top to the bottom to the top, usually you look at corrections ending between the two key numbers. It's 618 or the one-time extension, and you can kind of see exactly where the 618 ends right over here, right? You can see the 618. So we have multiple confluence. We had the one.
Yeah, by the way, when I'm looking at time, right, my time frame, I'm looking at a very big time. What you have done, you take my logic, right? So I'm looking at swings. I'm looking long term. When I'm using those time frames, I'm looking at the long term. You have basically repurposed my idea of using Fibonacci time and looking at the lower time frame. If it's working, great. But majority of the time, right, when I hear someone is using Elliott wave, I'm not a huge fan of Elliott wave. Many people are using it. Maybe we sucks at it. What's for that reason? But I like to look always behind what's in the markets happening, right? Not what's in front of me only, but what's happening in the background, what's actually people are saying and doing, right? So could say, okay, the market is gonna go high, but in the secret they are shorting the market, right? And what's happened recently with Michael Burry, right, closing his fund and his hedge funds, right? And which makes me question: is he seeing something, or is he just closed it because it's getting annoying? Is he seeing something, closed it so no one sees his trade,
I
or
think I think that you're definitely right. I think that Michael Burry knows that there's something going on, and um, he might be seeing things that a lot of people are not seeing, right? And I think that at the end of the day, the sentiment is very tough to read, especially in his case, because you know he's managing millions and billions of dollars, and markets climbing, climbing, climbing. His investors are saying, Michael, we want our money out. We don't want to short the market anymore because it keeps going higher. And then just when everybody starts to capitulate, that's when the market drops, right? So maybe he's onto something, right? And going back to the Elliott wave, right? I mean, Elliott wave principles are quite difficult to use on shorter term time frames. A lot of Elliott wave technical technicians, let's call them, use long term Elliott wave analysis to try to project the direction and the expansion and contraction in the market, because Fibonacci really is just expansion and contraction, right? That's why we use market mathematics aka Fibonacci's, right?
Exactly. So I think a detailed technical analysis will be in another video today. Let's focus on where the projection of the market's looking, right? So are you seeing it is going to be a long for you, or are you seeing in the short term a concern because of X and Y you are has seen that before, right? A pattern you have seen before. And
Right.
of course, patterns, what's happening in the past doesn't mean it's going to happen in the future. Okay, patterns is just like confirmation, right? And you combine it with a lot of other tools and analysis and views.
Mm-hmm.
It's just another confluence for you guys. Don't use just only patterns to predict the future. Will never happen.
Don't use patterns. Patterns are just one of the many tools that you can learn, right? But it should not be, it should never be trading off of triangles and, wedges. And, they did, to a certain degree, they give you some context, but I wouldn't say that they're the best tool to use, for example. And I think Mo would agree.
Definitely, definitely.
So, I mean, let's talk about what we think now, Mo. I think that maybe we share similar views here, and maybe we are seeing some bearish development in the market, right? And what I wanted to look at as, the bullish and the bearish scenario, I'm just going to get rid of this for now because what I think is interesting here is on the volume profile for the last 2 weeks here, we're seeing a range develop, right? And for those that are looking at, let's call it this shorter term time frame, you can see that since September 15th till now, we've essentially just been trading in the same spot, right? Um, and so, what concerns me is that while price trades in a range, we have no decisive action until price breaks out of the range, right? And we know that based on the volume profile, there's a few key regions where price is being traded at, right? So we know that the value area high, where market participants believe that this is considered a higher end of the price to pay. We have the point of control, which is the most traded zone, where the most amount of shares are traded. And then obviously we have the value area low, right? So generally with auction theory, whenever price loses major value areas and then reclaims them, they kind of look to them as failures. So, examples are here when price kind of reclaims, hits the point of control, fails, reclaims, hits the point of control, if it can sustain itself into the value area high. But let's just say generally within these ranges, right? I think that what's interesting now is that I have quite a lot of confidence when I see, symmetrical ABC patterns like these, especially after massive drawdowns like Mo. What are we looking at here? From the top to the bottom, we're seeing a correction of 5%, right? And, perhaps that might be something that is expected by most market participants. So let's think that if we are going to get some relief here, because we are trading kind of within this value area low, if price can get above here, hold, look at where the most traded point of control is. We have what maybe a lot of people look at this as a fair value gap or perhaps some kind of inefficiency. Would it be unreasonable for price to come up here? It could definitely happen. But the problem is that we're coming into some key resistance. We have the most traded zone where people might decide to sell. We have our Fibonacci golden pocket, which market mathematics would suggest that this is an area where the trend can potentially pivot, right? And so I'm really looking for, if we want price to go higher, I think that realistically price has to break through all of this major resistance, and it has to prove to us that it really wants to kind of hold this upper boundary of this range here. And really your confirmation is taking out this high, right? If price can take out this B pivot, I would say that the all-time high is almost guaranteed at that point. But until then, we're kind of more so concerned what happens here. Now, what's interesting is that whenever you see these kind of zigzags, as Elliott Wave would identify, you can actually extend these and combine them into what's called a combination correction. So what that means is that if we have a completed ABC pattern and we think, oh, well, let's look for the rotation back in the original trend, we want to make sure that this isn't the beginning of a bigger correction, which is called a W, X, Y. We call these combos. What does that mean? Is that whenever you have a first ABC, this is your initial pivot. And what essentially would create a larger WXY or a bigger ABC kind of zigzag pattern, right? And so if we get this price to kind of bounce here and then reject, well, we could be looking at a bigger correction here that's going to bring us, quite a bit lower. And at that point, if we're going to be looking at a drop, that might be another 5% drop. So you can see the symmetry here, right? You can see this 5% here, 5% here. We're talking measured moves, right? So we get the first leg down, relief, second leg down. So that's what I'm looking at right now, personally. I
It's
don't know.
very
The market's
interesting. Very
the
interesting
market
views, authors. Very
that's
interesting.
essentially what I think so far. But we'll see. We have big news coming out in 10 minutes. Perhaps we'll stay live here and take a look at the market reaction because we have the minutes, the FOMC minutes report being released in exactly 10 minutes now. So we might see some market volatility here very, very soon. And I would love to see what happens kind of going forward into the end of today. Of course, NVIDIA earnings. We've got a lot of volatility coming our way, folks. We got to be ready for what's coming here. And I think that what's coming is going to be explosive.
Very explosive. Let's see how Jerome reacts, right? On my point of view, I will share it with you guys. Thank you very much, Arthur, for sharing those technical information, how you trade those Elliott waves and what you are looking for, right? It is always great to see different views in the market. So what I have realized lately, right, through my journey of trading, many people think they are superior. The analysis is always superior to other person, right? If it's using Fibonacci, technicals, fundamentals, Warren Buffett, James Simons, quant trader, each one of them, every one of them is hate each other because they think the analysis is always superior. No one's analysis is superior. There is millions ways to make $1 million, right? If you can short companies greatly, do it. If you can long them greatly, do it. If you can long short portfolios, then do it. As is, you have different goal. Each person has different goal, maybe on the shorter time frame, maybe on a swing trade, which is between 3 to 20 days, maybe on a longer time frame, which is for me, everything long time frame for me is very simple rule. Everything above 6 months is a long-term trade. So that's being said, I wanted to share with you guys before that a trade which I was looking for, Russell, right? So when the cuts happens, the idea of Russell, right? Let me see if I can zoom in. So perfect. So idea of trading Russell, right? Russell 2000 or the ticker IWM. It is very simple. When the cuts happens, right, in the markets, I have posted that on my LinkedIn, by the way. When the cuts happens in the markets, the Russells moves up, okay, and we have a huge gap between the S&P 500, the QQQ, and the Russell itself, right? Those Russell contains smaller companies, 2,000 smaller companies, not blue chips like Apple, Facebook, Meta, which is called now, and Microsoft, etc., right? Tesla. It is more like a smaller companies. So it moves when economy growth kicks in and when investors are willing to take risk, okay? So is there risk in the market? Other people are willing to take a risk. So we need to check that ticker first. Are people risk on or risk off? So, and also the second condition which needs to be met, Federal Reserve cuts rate. Okay, so what we said, Federal Reserve cuts rates, the market drops, the smaller companies profit from it and get cheaper loans so they can pay easier their employees, expand their operations, etc., right? So the interest for foreign and dollar spending reduces and make access to the credit easier, right? That's being said, okay, if also the money printer goes on, the dollar weakens, right? We have talked about dollar, what's happened to dollar, right? When the money printer on, the dollar get weakened. Small caps usually benefit from that also, right? Because they earn domestically. And a strong dollar doesn't help them because it is a risk-on environment, right? And when it is risk-off environment, you see dollar index is going higher. So people are hedging or putting their cash. Cash is king, right? They're saying that. And also when the inflation fears go down, okay, which is happening with the goal of rate cuts to reduce the inflation, and also to protect people and the economy and make constant growth and keep inflation at 2%. There are two mandatory goals the Federal Reserve has, right? Make inflation stable, make economy grow. So when it comes down, as we said, it must be risk on, etc. Nevertheless, that's the idea. We have a 80% potential of going higher. 80%, okay? Doesn't mean it's gonna happen. More about that, okay? Because let's go back to the idea. Where was it? We were here talking about S&P, right? So we said when people, I think it was very clear over here. This one. Hold, buy and hold, right? The buy and hold strategy is a very stupid strategy in my opinion if you are just buying and holding. If you bought upstairs in 2007, okay, you would have by 2009 a 56 correction, which is gonna be destroying your account in 1 year, right? If you had a 100 million, you just left with 44 million. Your purchasing power went just lower than half. Okay, 50% and more. Your purchasing power, your credit lines, you couldn't borrow against it even, right? Maybe even liquidation event gonna happen to you if you were leveraged. But it took almost, okay? It took almost 130% return to go to the 0 point, the break even where you have interest. And more than how many years? More than 5 years, okay? 5 years no return. So everyone is looking at S&P 500, 10% annual return, etc. It's looking great over the last 30 years, but they forget the risk. They forget the liquidity problem, okay? That's being said, for that reason, I was so much concerned about you guys. So I put this point into my website, sentieninstitute.com. You can go there and check it out. A simple truth about buy and hold, right? It protects nothing. So buy and hold is basically, it says unmanaged risk. And drawdowns, you take it fully, right? And we said drawdowns, you take it fully over here as we showed you. This is a very huge drawdown, 56%. And additionally, it says cycles, okay? You're always exposed to drawdowns, always exposed to be in negatives, right? You are not protected. That's being said. Even Warren Buffett, I love his quote over here. Only when the tides goes out do you discover who has been swimming naked. So when a structure breaks, professional rotate and hedge and sit in cash. So preservation and protecting your capital is your only responsibility. You don't need to be exposed. You need to understand the markets, right? You don't need to be a day trader. You don't need to go into the market every day, but you need to understand what's happening in the market overall, right? So many people come to me and say, hey Mo, I went to a hedge fund, I put my money there. But they forget hedge funds. Majority of hedge funds lag, right, behind, and which is problematic. So your capital, I say, is your conviction. And the goal of hedge fund is take management and performance fee from you, right? And not to protect you in the first place. So let's see what's going on. So the drawdowns point, right? We saw 56% correction over here, and it took 140% to go back to where it was. That being said, it is very simple rule. This is very simple rule. It's called law of large losses. Okay, 56% over 100% return you need to go back. 60% is gonna be exponential, 150%, right, to go back to the break-even point. So many people just oversee when you look at this table, right? Let me zoom in. So when you look at this table, you see every year there is drawdowns, every year, and almost and between 5 to 15%, which is huge. And some years 20%, some years 33%, and the next year 22%, 2002, right? Those negative years in 1981, in 1962, right? It's just like, okay, what's going on? Very, 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 very bad. So that's being said, drawdowns is gonna be there. Your capital always unprotected when you buy and hold. Long short story. Okay, you need to understand how the market works in cycles. You take the longs, you take the shorts, you protect, you hedge, you set in cash. In this graph, you can see it very clearly, right? If someone is spotted here and went up, this means they had 20% return, and it went down to the entry level. They had negative returns because they had fees to pay and to buy the stock or the crypto, whatever. That's being said, let's move to a trader. A trader would have longed here, went upstairs somewhere approximately, right, and stopped at 20%, and take his profit and waited or hedged himself over here and then shorted, right? So he were left approximately with 32% ROI instead of 0. And that's why how you can beat the market, right? The benchmark. And anyways, the benchmark is this very obvious lies, right? So S&P 500 going up is correlated with money supply, how much the Fed printer is printing. So the more prints, the more S&P 500 goes higher. This means your purchasing power is almost always the same. So the moral of the story, buy and hold, isn't wrong. It's just incomplete. You need to understand the structure and not only hope, okay? And you cannot afford to wait until it doesn't work. Your capital needs structure, not hope. You built it, you earned it, you inherit it, so now it's your turn to protect it. That's being said, okay, let's jump to the next point. Who I am, right? Who I am, the guy who's giving you the advice over here. You can check it on my website, right? I have over 10,000 hours in the market, live tested indicators, over 101, build my own tools and dashboards, right? Right now, I have even built tools to analyze the market, artificial intelligence, right? That's being said, the point is, okay, you can read my story over here. What's my origin story, etc., right? With certification I'm pursuing and having. And the books I have read. And everything I built from scratch, right? But majority of people oversee that I have already ton of other stuff, right? Styling social media, right? Over 500, doing investor pitches, doing WordPress and SEO and competitive strategy for digital visibility, right? Operational and automation, which I have done for Zapier and Publi, right? And even doing a multi-Kanban system for multi-project execution, right? And finding the sweet spot of volatility modeling across market caps. So which market cap is working probably, and what's the best and the least stressful time frame to trade. And I've done some quantitative emotion, quantifying emotion using sentiment analysis and machine learning, right? Build a model which has 70% accuracy in predicting what's going to happen in the next 3 to 20 days, turning raw filings into insights and automating SEC data, right? From concept, click, Figma designs, human intelligence, right? HR stuff, right? Done over 100 interviews with people, structured operating architecture, this program which I have built for you, put all my knowledge, information, my pain, what I have learned in the shortest time frame to bring it to you, and so you can save the money and you can be the boss of your own finances. You decide whenever, whatever, however you want to trade, and not even rely on my own opinion, right? Of course, here's a couple of photos of me. You can check it out, right? It's just very fun. Go there and check it out. And one thing is very important, and the majority of people asking me how I can evaluate a trader, right? Evaluate a mentorship, evaluate a course. So I have made a couple of points, right? I call it red flag index. When it's between 0 and 9, it is high risk. When it's between 14 and 16, right? You give it each time when it is a point. If it's very good to excellent and transparency and clarity, you give it 2 points. If it's no evidence of proof and vague promises, you give it 0. Okay. So that being said, you can check it out, all those different points and how you can compare it. And you can compare my mentorship with other low cost community, high ticket intensive, etc. Right? And even with a bigger certification, CFE, CMT, FRM, and CQFs, CIA, etc. Right? And you can see it yourself. I've done the analysis for you, but you can obviously come here and download this over here. Excel sheet will gonna help you to analyze it, right? You put information in it, the pointers, the provider A and B and C, etc. So you can see it yourself, right? Even awaited in different way, an explanation, also everything for you done it. That's being said, the only thing is built, right? And CoinGlass, everyone is saying the bull market peaks indicator. It is at right now, it's saying us to hold, right? It's telling us to hold. So holding the market while it's dropping, right? It's not that great idea, because I have paused it recently. I'm looking for this trade over here, which I'm in it, right? So if it goes higher, I will short it again and compound my shorts, because I see a market correction and market is dropping. Majority of people, I don't care what they are doing. This is my view, and it's my opinion, and it's my trade. So you need to have your own trades and your own opinions, so you can be independent and not relying on anyone's signals. And that's exactly what I'm teaching people, to become more independent and learning from my skills and mistakes. So over here, I took a long trade, by the way, because I was looking at it. It was an A plus trade for me. I took it, and now I am in a hedge position, right? So that trade was exactly over here like this. Right now, I am in a hedge position. So I would believe it could go lower, right? This one, a hedge position against my short. And right now, I'm hedging against my shorts again. So it's very complicated, but simple rule. If you don't know what the market's gonna do, sit there and cash. Okay? Don't try to predict the market. Your job is not predicting the market, it's reading the reality, the current present, very clearly. So that's being said, long story short. When Fed cuts, okay, the market drops. If we see a third cut, market drops. Statistic telling us market's gonna drop, right? Over here, Monte Carlo. I'm looking at a short in Bitcoin. You can check my website, and then stand by and hold is not the perfect strategy. And you can check my story information to learn more about me. And third thing, the most important one for you, how to qualify anyone in trading industry. Everything else, don't overcomplicate it, stay easy, and it is simpler than you think, and it is difficult than you think if you focus on the wrong things, and the wrong thing is noise. So reduce your noise and try to come up with your own thoughts. And if you need help, I'm gonna be here in the comment section. You can share it or message me on LinkedIn straightforward. So I'm gonna give the final word to Arthur if you have anything to say.
That was well said, Mo. I think you did a great job. I think that everyone needs to take some of those remarks and remember that you got to be able to think for yourself. A lot of people follow the crowd, a lot of people follow the noise, and we all make mistakes. But I think the most important thing is to learn from them. And one thing that I will add is if you are looking to invest your money in the markets, your job is not simply to blindly have faith in the outcome that can, and nobody really knows what it can be. But your job is to always keep an idea that you need to manage risk. And if you can manage your risk, keep your losses small, notice the time when there's opportunity, and notice the time when you need to sit in cash, then you will be a very successful investor. And I think that we can end it on that note.
Right. Well said, Arthur. Everyone, I wish you the best and wish you success in trading. Don't complicate it. Focus, focus, focus. And see you next time, everyone. Happy
Thank you,
holidays
guys.
and happy December and happy Fed Jerome. So by the way, we said Jerome is coming out right now, right? He should must be live right now.
Well, we do have the, he's not going to be live, but we have the Fed minutes released. So I think that if you can try to pull out Fed minutes here, let's see if there's any type of report that
So
I
I'm right
pulled
now
up.
on Trading View. Let me see on Trading View if the reports just came in. So the Fed minutes. Okay, in the United States, the authority to set interest rates. Okay, let me share my screen.
Yeah, I see it here.
So, in the United States, is the authority is to set interest rate is divided between the board and of governance and of the Federal Reserve Board. The Federal Open Market Committee, the FOMC, the board decides on changes in discounts rates after recommendations submitted by one or more of the regional Federal Reserve banks. The FOMC decides an open market operation including the desired level of central bank money or the desired federal funds market rate. So the forecast is to remain same in October. Or in October was looking for cuts, which has happened. We showed that, right? So do you have the chart, Arthur? You said. Let me see FOMC. So you are muted, Arthur, by the way.
So if you just go on the federalreserve.gov website, you can just type in federalreserve.gov. Yeah. And then, yeah, Fed Open Market Committee for October. And then if you go to the PDF there, look at the bottom there on the board's website. Yeah, so they have
So
this, and they also have a statement. So you know what? Go back for me, if you like. They have a statement. I was just looking through the statement here. Click on that same link actually that you were just on. Yeah. Now go to the part where it says this could be viewed on the board's website. Yeah, go ahead and click that right there in the
where
middle. In the middle? No, in the
this
middle of the text. No,
website?
go. Yeah, right there. Exactly. Click that. Open that up. Now scroll down and look for September right there, October. Yes, release November 19th. See there, press conference. Now we have a statement. Click on the PDF on the statement.
Wait a minute. This is like
Yep,
2025
that's the one.
press
See,
press conference, right?
that's from July. We got to go to the one on October. So right there, yeah, press conference. Exactly. This one right here. This is the one
Oh
where
yeah,
right
yeah,
on
yeah.
the right it says
Implementation note. I see. So a quick summary, right?
hmm. So I'm just wondering, they should have the press conference. Oh, it's live now.
Yeah. I think let's forecast it. I will do it over here in the screen so you can see it also. So, are you watching with the guy? What's his name was the stock market reality?
I'm gonna see if he's watching it live here.
Okay, let's see. Stock
I'm not
market.
sure if they have a live. I don't think they will have a live conference. I think they might have just released. They might have just released the press release for now on the minutes. Let's see.
So the stock market live guy, he is not
Yeah, it
seeing
doesn't
the
seem
stream.
like there's anything today.
So yeah, doesn't mean he has anything. So basically, what's happening over here? right? Let's see. So I'm gonna run this into ChatGPT, right? So give me a quick summary of it, so we don't need to waste everything in here and what's actually saying sometimes, right? So quick summary.
Seems like the market doesn't really care that the minutes came out.
So yeah, let me check the markets also, right? Let's we check the market first. I have over here, right, the screen. So what's going on over here? So the bonds markets, we are right now on the 5-minute time frame, right? The bonds markets just dropped a little bit, and volatility has remained same. The S&P 500 dropped. What just rose? Dollar index, just like crazy, is going up since today. You see, it's just like,
Yeah, I see that.
just crazy going
That's not
up.
great, eh? Dollar
Oh
rising
yeah,
is
this
not
is
that
behind
great for
my huge face. Let me turn off my huge
Holy
face.
cow.
So yeah, it's just like crazy moving up. And
Everybody's thinking that
Bitcoin
the
is
dollar's
just
gonna get
going
destroyed.
down. Gold is also going down. So gold going down. And oil, what the fuck? Oil is happening. 3%, 19th of November today. Just 3%. Okay. It's pretty volatile, right?
Mm.
That's being said, Bitcoin is going down, dollar going higher, volatility remains same after a pump. So logically, this market should have dropped a little bit, yeah, which is done, right? So it's dropped. So yeah, basically is what we are seeing here. It's very clear. So the Fed interest rates wanna cut rates, right, by 25%, bring it the federal funds target to the range of 3.75 to 4%, and interest on reserve balances should be 3.9, and primary credit discount rate 4%. So the implementation is telling us that the Fed instructed the New York Fed Open Market Desk to keep the federal funds rate within the new target range. Offer overnight repo operation, liquidity injection with a 4% minimum rate and 500 billion limit. That's a crazy number, 500 billion. And also the overnight reserve repo operation liquidity withdrawal should remain at 3.75% within 160 billion per counterparty limit. Those are huge numbers. Balance sheets and yeah, quite massive, right? So the balance sheets and reinvestments in October, the Fed will limit Treasury reinvestment to 5 billion a month capital, right? Continuing a light balance sheet reduction. So they want to reduce their balance sheets slightly by injecting the market slowly, right? That's being said. So it doesn't manipulate the market themselves, right? On September 1st, it will fully reinvest all maturing Treasury and agency securities into short-term Treasury bills, signaling the end of quantitative tightening, right? So it is basically telling us it is end of the quantitative tightening, and it's gonna be making easing. So what it means actually, the Fed official pivots towards easing, cutting rates for the first time in the current cycle. Liquidity tools, repo and reverse remain in place to control short-term funding rates. The move hints that the Fed sees a slower growth or cooling inflation, and it is preparing to support the economy going into 2026. Basically, the market will go down. What's exactly what I have been trying to say, right? So I'm seeing short-term and in the long term, the next couple of months, the market dropping on S&P 500 based on the quantitative easing which we happening and the statistic we are seeing it again, right? That being said, everyone, I think that was a great overview of my methods and my views in the markets, and I wish every one of you great success to be a millionaire, to be a billionaire, and as much money as you like. And see you next time with much more content, with much more information, with much more value to help you to become much better trader and someone who is protect his wealth with statistics and strategies and the right information. See you next time, guys.